Good morning and namaskar. This is the third monetary policy statement of the current financial year, and the statement is as follows. In my statement of 4th May to get through this difficult period, it is necessary to be sensitive to the new realities and incorporate them into our thinking. The war in Europe is lingering, and we are facing newer challenges each passing day, which is accentuating the existing supply chain disruptions. As a result, food, energy, and commodity prices remain elevated. Countries across the world are facing inflation at decadal highs and persistent demand-supply imbalances. The war has led to also getting affected. During these difficult and challenging times, the Indian economy has remained resilient, supported by strong macroeconomic fundamentals and buffers. The recovery has gained momentum despite the pandemic and the war. On the other hand, inflation has steeply increased much beyond the upper tolerance level. A large part of the rise in inflation is primarily attributed to a series of supply shocks which can be linked to the war. In these circumstances, we have started a gradual and orderly withdrawal of extraordinary accommodation instituted during the pandemic, that is the COVID-19 pandemic. Similar to our resolute and timely actions to limit the economic damage emanating from the COVID-19 pandemic, the Reserve Bank will continue to be proactive and decisive in mitigating the fallout of the ongoing geopolitical crisis on our economy. We have already reprioritized our policies to control inflation without losing sight of the growth requirements. Our approach underscores a commitment to move towards normal monetary conditions in a calibrated manner, and our steps will be measured. We will remain focused on bringing down inflation. Let me now focus on the decisions and deliberations of the Monetary Policy Committee meetings, the meeting which we had recently. Against this background, the Monetary Policy Committee, that is MPC, met on 6th, 7th, and 8th of June, and based on an assessment of the macroeconomic situation and the outlook, the MPC voted unanimously to increase the policy repo rate by 50 basis points to 4.90% with immediate effect. Consequently, the standing deposit facility, that is the SDF rate, stands adjusted to 4.65%, and the marginal standing facility, that is the MSF rate and bank rate, to 5.15%. The MPC also decided unanimously to remain focused on withdrawal of accommodation to ensure that inflation remains within the target going forward while supporting growth. Let me now explain the MPC's rationale for its decisions on the policy rate and the stance. The protracted war in Europe and the accompanying sanctions have kept global commodity prices elevated, and this is across the board. This is exerting sustained upward pressure on consumer price inflation well beyond the targets in most of the economies in global financial markets. This is feeding back into the real economy and further clouding the overall outlook. The MPC noted that in such challenging global environment, domestic economic activity is gaining traction, while inflation pressures have intensified further. The upside risks to inflation, as highlighted in the April and May 2022 policies of the MPC, have materialized earlier than anticipated, both in terms of timing and magnitude. Inflationary pressures have become broad-based and remain largely driven by adverse supply shocks. There are growing signs of a higher pass-through of input costs to selling prices, that is 22-23. In this context, supply-side measures taken by the government in reducing excise duties on petrol and diesel, along with other measures, would help in mitigating the inflationary pressures to some extent. The MPC also recognized that sustained high inflation could unhinge inflation expectations and trigger second round effects. The MPC therefore judged that further monetary policy measures are necessary to anchor the inflation expectations. Accordingly, the MPC decided to increase the policy repo rate by 50 basis points to 4.9%. The MPC also decided to remain focused on withdrawal of accommodation to ensure that inflation remains within the target going forward while supporting growth. It may be noted in this context that the repo rate still remains below its pre-pandemic level. I would now like to provide an assessment, a more detailed assessment of growth and inflation. And first, I would like to take up growth. According to the provisional estimates released by the National Statistical Office, that is 21-22 is estimated at 8.7%. This level of real GDP in 21-22 has exceeded the pre-pandemic, that is the 2019-20 level. On the supply side, major categories also surpassed the 2019-20 level. Available information for April and May indicates that the recovery in domestic economic activity remains firm, with growth impulses getting increasingly broad-based. Manufacturing and services purchasing managers indices, that is the PMI, for May point towards further expansion of activity. This is also corroborated by movements in railway freight and port traffic, domestic air traffic, GST collections, steel consumption, cement production, and bank credit. While urban demand is recovering, rural demand is gradually improving. The contact-intensive services related to trade, hotels, and transport have recovered in Q4 of 21-22. Going by the early results of our surveys, capacity utilization in the manufacturing sector increased further to 74.5% in the fourth quarter of 21-22 from 72.4% in Q3 of 21-22. So that is in the last financial year, 21-22, between Q3 and Q4, the capacity utilization in the manufacturing sector increased from 72.4 to 74.5%. Capacity utilization is also likely to increase further in the current financial year. Investment activity is thus expected to strengthen, driven by rising capacity utilization, government's capital expenditure, and deleveraged corporate balance sheets. Improvement in investment activity is also reflected in pickup in demand for bank credit and persisting growth in imports of capital goods. Merchandise exports have remained buoyant with double-digit growth for the 15th successive month in May this year, while high growth of non-oil, non-gold imports is indicative of recovery in domestic demand conditions. Looking ahead, real GDP is expected to broadly evolve on the lines of the April MPC resolution. The forecast of normal southwest monsoon should boost kharif sowing and agricultural output. This will support rural consumption. The rebound in contact-intensive services is expected to sustain urban consumption. Our surveys suggest further improvement in consumer confidence and households' optimism for the outlook a year ahead. Business sentiment remains upbeat according to early results of our surveys. Nevertheless, the negative spillovers from geopolitical tensions, elevated international commodity prices, rising input costs, tightening of global financial conditions, and slowdown in world economy continue to weigh on the outlook. Taking all these factors into consideration, the real GDP growth for 2022-23, that is for the current year, is retained at 7.2%, with Q1 at 16.2%, Q2 at 6.2%, Q3 at 4.1%, and Q4 at 4%, with risks broadly balanced. I would now like to focus a little more on inflation. The CPI headline inflation in April registered a further sharp increase to 7.8%. It was the fourth consecutive month when inflation touched or was above the upper tolerance level of 6%. The surge in headline inflation was seen across all major categories. The global geopolitical situation remains fluid, and commodity markets remain of a normal southwest monsoon and Kharif agricultural season. The recent supply-side measures taken by the government and the unfolding of their impact, lifting of palm oil export ban by a major supplying country, that is Indonesia, and signs of moderation in global industrial metal price indices. Our quick survey of urban households undertaken after the excise duty cuts of petrol and diesel on May 21st shows a significant moderation in inflation expectations of the urban households. And we notice declines of 190 basis points in their 3-month ahead expectations and 90 basis points in their 1-year ahead expectations. In such a scenario, further reduction of state VATs on petrol and diesel across the country can certainly contribute to softening the inflationary pressures as well as the inflationary expectations. Notwithstanding these positive developments, commodity prices, the recent spike in tomato prices, which are adding to fuel inflation, and most important of all, the elevated international crude prices. With assumption of a normal monsoon in 2022 and average crude oil price in the Indian basket of $105 per barrel, inflation is now projected at 6.8% with risks evenly balanced. It may be noted that around 75% of the increase in inflation projections can be attributed to the food group. Further, the baseline inflation projection that we are making now at 6 and 7% for the current year, it does not take into account the impact of monetary policy actions taken today. Between February and April, headline inflation has increased by about 170 basis points. With no resolution of the war in sight and the upside risks to inflation, prudent monetary policy measures would ensure that second-round effects of supply-side shocks on the economy are contained and long-term inflation expectations remain firmly anchored and inflation gradually aligns closer to the target, or rather close to the target. The monetary policy actions including at an interest rate of 3.75%. This was effectively a rate hike of 40 basis points over the fixed rate reverse repo of 3.35%. As a result, the weighted average call money rate, that is the WACR, which is the operating 54% during April 8th to 30th. WACR, that is the weighted average call money rate, because there was a rate hike on May 4th, as you would recall. In line with the emphasis on gradual withdrawal of accommodation articulated in the MPC resolutions of April and May, systemic liquidity has moderated in the recent period. Surplus liquidity as reflected in average daily absorption under the liquidity adjustment facility, that is the absorption under SDF and the variable rate reverse repo auctions of 14 days and 28 days at 5.5 lakh crore. If at 5.5 lakh crore during, nevertheless, the overhang of excess liquidity has resulted in overnight money market rates on an average trading below the policy repo rate. At the longer end of the money market term structure, interest rate on 91-day treasury bills, commercial papers and certificates